Now, although they've had valuation levels similar to their counterparts in South Africa and the developed world, African markets do offer superior prospects for growth. This is according to Prescient Investment Management. So we've got Johan Steyn, who's a portfolio manager and analyst at Prescient, joining us from Cape Town for some insight into investing in Africa right now. Johan, African markets have certainly been fantastic performers. If you've been invested in the African markets in the last year and a half, you would have made some good money if you're locking in those profits right now. So what are we expecting from here on out from the delivery in these markets, and where do you see the sectors that are going to drive the performance? Because very much consumer stocks have been at the forefront of investor demand in the past year or so.
Yes, hi Samantha. African markets have certainly really well going into this year on the back of good momentum last year, and this has just largely been due to international investor flow as they've been trying to get exposure to this African growth story on the back of really low global interest rates. And so what we've seen is these portfolio flows predominantly chasing your African growth story and trying to access that African consumer growth story by buying those consumer-facing shares. Mm-hmm. So these shares have done really well for the last 12 to 18 months and delivered strong stock market performance. But what we've also seen is that we haven't really seen earnings delivery in those type of shares. So they have actually re-rated and become more expensive, going from, on average, if you just look at the Nigerian consumer sector on average, for example, they've re-rated from a price earnings ratio of around about 24 to over 30. And if you just compare that to financials, who's also been a recipient of international portfolio flows and also had strong market performance, that actually had some earnings delivery. So the likes of your tier one banks in Nigeria, for example, their valuations actually tracked sideways over this.
So when do you expect the re-rating in that sector? And what do you think it's going to be driven by? Because there has been a slight uptick in some of those banking stocks. I mean, certainly from the Nigerian perspective, from the crisis. But when do you expect that sharp re-rating in the financial sector in Nigeria specifically?
So it's not necessarily a expectation of a re-rating as such, but just that there is a valuation underpin if we see a scenario or a risk-off scenario emerging where international investors actually rotate out of frontier markets and actually trying to take some risk off the books in a scenario where Fed tapering is actually experienced. So looking forward, financials and over like the medium to longer term, financials and especially your banks in the likes of Nigeria, it still makes good sense to allocate to them as economies develop. Your financials are typically well placed to benefit off of that development, to benefit off of economic growth. So as some sectors develop, your financials are there to provide financing. They finance your larger infrastructure type deals. And Africa's still got a long way to go in terms of financial intermediation. Just the retail banking penetration is still extremely low, not only in Nigeria but also in surrounding countries as well. So your financials still have a lot of potential to keep growing those earnings. Although they've grown them, there's still a lot of momentum available there. So just in both scenarios, in a continuation of international flows, financial makes sense, and if there is a re-rating, you'll benefit off them, and if not, if they just maintain the same rating, you'll still do well as they are still growing their earnings.
I mean, from an outsider's perspective right now, if you aren't looking at the markets on a daily basis, perhaps you would look at, for example, the Westgate terrorism attack as a reason not to invest in Africa, given the uncertainty around the rise in terrorism, for example, in Kenya and Nigeria as well. So what are your thoughts in terms of looking from the markets from that angle in terms of the risk of an event like that? I mean, we haven't seen a knock-on effect to the Kenyan market, but from your investment perspective, do you see these as factors one needs to consider from a stock exposure?
Well, Samantha, there's been unfortunate, that or these events have been really unfortunate in Kenya. For example, it's not only been the terrorist attack, but they've also, experienced the fire at the airport. And these events have, they headline grabbing events. And but at the end of the day, they are isolated events. So your terrorism in northern Nigeria, for example, and terrorism events like what we've seen in Westgate in Kenya are quite isolated in terms of the market impact. So as you rightly mentioned, there hasn't been a knock-on effect in the Kenyan market. Mm-hmm. There's actually been an uptick in the Kenyan market over the week. So because the market impact of an event like this is fairly constrained. Where we do see an impact, though, is on a more macro scale, is that your tourism levels in Kenya might be impacted over the short term, which is a big generator of foreign income for the country. And then also, I think this has strengthened the Kenyan government's resolve to actually intensify their efforts in Somalia. So you might see some increase in fiscal spending to bolster your security. And that might put strain on the already stretched deficit. Okay, so we have those two, I think, macro impacts from an event like this. And as you also mentioned, there is the bigger risk of an escalation of this type of terrorism, where if this gains momentum, it can cause a more wider insecurity or instability, which then might, impact, have an impact on market or capital markets and on a company's bottom line.